If you're a business owner and you're looking to upgrade your company car, you won't want to miss this. The ATO, the government, just came out with a new set of rules that will allow you to save tens of thousands of dollars on a new Tesla. That's right, with the fringe benefits tax exemption on electric vehicles, you could be driving a state-of-the-art Tesla for just a fraction of the cost. In this video, I'll show you how to take advantage of the new rules and unlock the potential of the FBT exemption for your business. Stick around to the end of this video where I'll also be sharing some tips on how you can make the most of your new electric vehicle and boost your bottom line in the process. As a business owner, you're always looking for ways to save money and get ahead of the competition. One area where you may be able to have significant savings is through your company car. Whether you're currently driving a Lemon or you're looking to upgrade to a more luxurious model, the chances are that you are overspending. That's where the fringe benefit tax exemption for electric vehicles comes in. If you're not familiar with fringe benefits tax or FBT, it's a tax that employers have to pay on non-cash benefits that they provide to their employees. Think of it as like a payment to an employee, but just not in the form of cash like a salary or a wage. This can include things like a company car being made available for personal use, employers giving employees tickets to sporting events or concerts, or where an employer just reimburses an expense for an employee like their personal health insurance. It's designed to ensure that employees are paying their fair share of tax on all of the benefits that they receive. However, there's some new rules that allow employers to provide electric vehicles to their employees without having to pay this fringe benefit tax. To qualify for the EV FBT exemption, that's a lot of acronyms, the car has to have zero or low emissions. The ATO has said that this includes all battery electric vehicles, all hydrogen fuel cell electric vehicles, and plug-in hybrid vehicles. It won't apply to hybrid electric vehicles that run mainly on liquid fuels. To qualify, the car actually has to have a rechargeable battery that can be recharged by an external source. And there are some more rules about which cars will and won't be eligible for this exemption. The ATO has ruled that there's a price ceiling for which cars will be eligible for the exemption. So the car's first retail sale has to be below the luxury car tax threshold. And for the 2023 financial year, that is $84,916. So if you buy the electric vehicle for less than $84,000, then you should be eligible for this exemption. So this will rule out cars like the Audi e-tron, Mercedes EQC, Porsche Taycan, the Tesla Model S and Model X. But you could still choose from the following cars: the Tesla Model 3, the Polestar 2, Kia EV6, or Hyundai Ioniq 5. These are just some of the more popular examples of the cars that are eligible, but as long as your EV is below that luxury car tax threshold, you're good to go. These cars are still typically more expensive than their petrol or diesel counterparts, but that's where this FBT exemption comes in. By taking advantage of this exemption, you could potentially be saving tens of thousands of dollars off the cost of a new EV. So how does it work? Let's say you're a business owner and you're in the market for a new car for your spouse. You have two options. You can purchase a Tesla Model 3 that you spec'd out to be $67,200, or you could choose its petrol equivalent, let's say in this example, a Mercedes A250. Hang on, pause. Before I get into this next part, we need to talk about how FBT is actually calculated on a car. There are two ways. The first is the operating cost method, which is calculated based on how much it actually costs to operate the car. If you use this, you must keep a logbook to separate the business use and the personal use of the car. And the second method is called the statutory method, which is actually calculated based on how much the car costs. If you don't keep a logbook for the operating cost method, you have to use the statutory method. But if you do keep a logbook, you can actually choose between the methods, and you'll usually choose the one which will leave you paying less tax. The big deal with these new rules is that it doesn't matter if you use the EV for personal use. You're not going to have fringe benefits tax to pay anyway, which makes it perfect for our example. Your spouse doesn't work in the business, so the car is going to be 100% for personal use. You probably wouldn't bother keeping a logbook because you can't claim any of the operating costs as a deduction, and therefore you will have to use the statutory method. So if you buy the Tesla for your spouse, you can get back $5,886 immediately by claiming the GST that you paid. And you can also do this if you buy the Mercedes. With both cars, you can claim a $58,855 tax deduction under the temporary expensing rules, which will save you $14,714 of tax. The Tesla is eligible for the FBT exemption, so there's no FBT liability that you have to pay. However, the Mercedes is not eligible for these new FBT exemption rules, and so you'll end up having to pay FBT. You'll have to use the statutory method, and this comes out to $13,114. But you do get a tax deduction for the FBT bill that you pay, so that's going to be a $3,285 deduction. So at the end of the day, if you buy a $67,200 Tesla, after your GST credits and your tax deductions, you're actually going to be paying $46,600. That's a $20,000 saving. You can see the difference between buying the Tesla and the Mercedes is a $9,855 difference. This exemption could be a game changer for you. You're saving nearly $10,000 and you get a brand new EV. But there's always a catch. Even though there's no fringe benefits tax payable, the benefit still counts as a reportable fringe benefit amount. So an employer still has to calculate what is the taxable value of all vehicles that they provide, and employees still need to provide the amount of benefit that they receive on their tax returns. Does this matter? Maybe if you have any of the following. If you have a study loan, if you pay child support, if you don't have private health insurance and therefore have to pay the Medicare levy surcharge, or if you're on the cusp of the $250,000 Div 293 tax threshold, then it's in your best interest to keep your reportable fringe benefits amount as little as possible. So how can you take advantage of the FBT exemption and start enjoying all of the benefits of a Tesla for only a fraction of the cost? Here are a few tips to get you started. First thing, talk to your accountant. The FBT rules can be complex and it's important to make sure that you're following them correctly. Talk to your accountant to ensure you're taking advantage of all of the available tax incentives and not getting in trouble. And the second tip that I have for you, as I tell all my clients, is don't spend money just for tax savings. A tax deduction is not free money. You're spending $1 to get back 25 cents. That's not a scalable strategy. If you were going to purchase a new car anyway, this is just a new strategy that you can take to your accountant to save tens of thousands of dollars on the purchase of a new EV. And if you want to pay even less taxes, watch this video next for 7 secret tax deductions you might not have considered.